So global stock markets rallied yesterday as we got what feels like a pause, temporarily at least, between the US and China tariff tensions. So I want to rewind the clock a little bit, help you understand how we got here, and that'll help us understand what the path forward could look like. So back on April 2nd, we had what was called Liberation Day, and that was the US announcing tariffs on lots of countries globally. The markets did not react well to that news. And our thesis has been that as tariffs escalate, that's going to likely spill into increasing the cost of goods for consumers and for businesses. And as demand starts to weaken and they pull back their spending, that could tip the economy into a recession in the US, and that could ultimately affect stock prices. That's been the bear case and part of our base case, effectively. And the stock market fell 20% peak to trough during April, as that narrative started to permeate and as tariffs escalated between US, China, and other countries. But if you fast forward to today, we're sitting here in mid-May, the market has essentially regained that entire drawdown. It rose almost 20% from the lows, and the S&P 500 today is sitting on the year roughly flat. So it's amazing when you zoom out. It looks like the market's been all calm on the surface, but underneath the surface, obviously a lot of volatility. Now, yesterday we got the first feeling of relief in those global trade tensions because the US and China announced a 90-day pause, temporarily paused on the tariff escalation. So they basically pulled back the US tariffs on China from 145% to about 30%, and China, their tariffs on US imports from 125% to 10%. So that's good news. Secondarily, this morning we got a positive CPI print. So that means inflation was a little bit softer than the economists had forecasted. It's the third month in a row, actually, where inflation came in light. Also good news. And the third thing we're monitoring is that technicals have actually started to firm up quite well. The S&P has now regained its 200-day moving average, and it's a key technical indicator that gives us a sense for the longer trend and path for the overall market index. So zooming out, tariff relief has started to happen. That's a good sign. The technicals, we've regained some key moving averages, at least in the very short term. And inflation's also been much more muted, which suggests that companies are not being as quick as many thought to raise the cost of goods as this tariff war has started to play out. Maybe they're still working through stockpiles of inventory, and that's also good news. So it's a little bit too early to conclude that the coast is clear and it's time to go all in and buy again. But certainly we've been surprised by just the magnitude and the speed with which the market has bounced off the lows in April, which seems to indicate that people believe the worst is behind us, that the trade war, that the US and China are going to respectively back down from some of that escalation. And if that happens sooner than later, that will in fact more than likely help the US avoid a recession, and that'll be very well received by markets. So we're still monitoring data closely. It's a little bit too early to conclude that the worst is behind us, but certainly we're seeing several of our key signposts firm up, and that gives us optimism that we will be in a position to start to go more heavy in terms of our equity exposure in the next coming weeks and months. So with that, let us know if you have any questions.